Shanghai also managing to hold on to decent gains of more than 1.5%.
The budget is also likely to support domestic shipbuilding operations.
23,200 level is very, very close by. We left off at 23,155.
The interaction fabric and the IoT fabric, we are seeing good traction and reception from customers.
We got a subdued start, so it's about 23,100 on the Nifty.
Year to come appears to be a year that will have sustained, robust, and very solid growth.
We hope to be around 6.5 barrels per barrel.
One bid responsive or qualifying the eligibility criteria.
And it's a much better looking screen, especially when you look at the broader markets.
So we do believe GenAI potential could probably be our that way forward persistent.
I really think in AI the incumbents have a huge advantage.
Sharp recovery from what was essentially a very sharp sell-off yesterday.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Okay, well, the bounce back continues, and it's been a decent day for the Nifty Bank, but especially for the broader markets. And, mid caps and small caps, it had been one-way pitai, if I can call it that. But today, I think there is a little bit of bounce which is coming through. Mid-cap IT is surging, but it's not just that. So much more going on. This is Closing Bell. Last hour coming up. I'm Prashant. With me, my colleagues Rima and Surabhi here in the studios. Nigel is joining in from the studio. Guys, hi.
Hi, afternoon, and not doing bad, right? I mean, there's been green, it's been fairly steady, and I think the mid-cap comeback after yesterday's dropping. Actually, the comeback started yesterday, and it's continued this, this afternoon. So it's looking good.
It is looking good, and I was just wondering, pitai is such a better word than rubbing, no?
More impact.
It just captures the essence of what has happened. But yeah, I mean, it's been, the market had sold off, it was looking oversold. Actually, for the last couple of days, it's just that, I mean, it turns when it turns. Is everyone confident that this is the turn and, I mean, this is going to take us higher sustainably? I don't think that confidence is back yet. But, people are starting to buy, pick and choose in individual names. So, I mean, some repair, some recovery, and that's essentially the story for today. Now, broader market is also seeing a decent bounce. The last I checked, I think about 2% of the small and mid-cap indices. IT index 2%. Rima will tell us more. I mean, Coforge set the tone, and it's just been one way across. But Persistent and Zensar and Emphasis and so many more. Just two levels. Nifty needs to cross nothing but the swing high, recent swing high, which is Tuesday's high. 23,426 is that level. 200 points from where we are. And Bank Nifty for the swing high, similar number, is 49,650. The high of the Tuesday. So you need to basically get above that, and then I think we'll talk more repair and recovery. But it's day by day, and you'll have to take it as such. Rima.
Well, in the mid-cap space, it's IT. So Coforge, Zensar and Persistent, all three up more than 10%. But even an Emphasis and Cyient, both report numbers later in the day. And Emphasis is up close to about 5.5%. So across the board, there is a rub-off impact on IT names. Birlasoft on large volumes is up close to about 4%. The other pack where there is a bounce back are the EMS companies after yesterday's drubbing or pitai. So you have a Dixon Tech up nearly 4%, Amber Enterprises up 8%, Keynes is up close to about 5%, PG Electroplast also higher. So that's another smart looking space for our markets today. And then you've got the likes of Swiggy, Go Digit, some of these new listings, new age companies higher in trade. But on the way down in the frontline pack, what's hurting is Reliance Industries. That's down nearly 1%, so that's weak. BPCL, Axis, HUL under pressure. But look at UltraTech, and I think we're going to leave it to Nigel to tell us more. 6%.
Absolutely. I was like, for me, I think this is the result of the season so far, because you can argue on IT, I mean, the positioning here and there, but on UltraTech, this kind of a performance, Nigel, wow. I mean, I think you'd be happy on all counts here.
Well, that's right. Before we get to that, I just wanted to make one quick point that these bounce backs that you're seeing in stocks, it's earnings-led reactions. And I like that. Today it's been that sort of a day, and I'm wondering whether or not these past few earnings surprises that we got, it can help Nifty go ahead and keep its record intact. What is that record? We haven't seen 4 negative months in the last 24 years or so. Because as of now, January we're still down close to around 2%. In the last 3 months, we have been lower. So the bulls will want to keep this record intact and will like to avoid, 4 straight months on the losing streak. So as I said, it's been 24 years since we saw that. The last time around, we saw it between June to September 2021. The Nifty ended lower for the 4th straight month that time around. So what's the number you have to track from here on? The 23,645, it's the crucial mark. The bulls will want to take the Nifty in the next 6-7 trading sessions above this by the time we end this mark. So hopefully we can do that, and we'll keep that record intact, because for the last many years we have seen 3 sessions the Nifty has been on a losing streak. We have witnessed that, but it's not managed to get to that 4th straight session. So hopefully the record's intact, and the bulls can claw back. I think we have to require around 300 points from here on. So I just thought I'll put that data point on the board. We're trying to look at some positives. Positive earnings reactions is what we've seen, and maybe that could take Nifty over that line of around 23,645 odd. So that's about the data point. We'll get to UltraTech in just a bit. For the time being, let's get in Mitesh. Mitesh, I just thought I'll put out that data point. What's your take? The Nifty has more to go from here on, or do you think it's showing signs of tiring a little bit?
Well, I think the good thing is that the expansion on the negative side has stopped. That would mean that we might not decline as much, and therefore a choppy base building activity between 23,370 and 23,370 and 23,000 could happen. I think once this base building is complete and we get some signs of reversal, then I'll go long. Otherwise, still waiting it out on the index. But as you rightly highlighted, it's the IT names, which are showing good traction, and that's where the up move is coming from. So I have a buy on Wipro with the stop at 312. Look at targets of 330 here. And also a buy on Grasim, which I would recommend buying with a stop at 24.25 for targets of 25.10.
Okay. All right. Got that. Mitesh, thanks very much for it. Well, let's kickstart the show then with a really important story that impacts, a lot of the mining companies and obviously the listed mining stocks as well. And this relates to Karnataka. Remember, Karnataka, just I think a couple of weeks back, came out with a ruling. There was a ruling that said that the state has the right to levy higher taxes on the minerals that are being mined in the state, and this could be retrospective. Now it seems there's a twist to that story. So let's go across to Sudarshan to understand what's the latest. Sudarshan, help us, get through this.
So it was last month that we had reported that Karnataka Legislative Assembly had passed mineral tax bill, and this bill had 2 major clauses. The first, it would tax retrospectively on the mineral tax, and it would be as per Supreme Court order. Second was, it would look to increase the duty on mining. Now what I have been communicated from Karnataka Governor Office, that Karnataka Governor has decided to return the bill to Karnataka government seeking certain clarifications. And the Governor is seeking clarifications after some of the mining associations have approached Governor raising concerns majorly related to these 2 issues. First one is retrospective, but it's as per Supreme Court order, so it's not be a major issue there. But second, the major issue is that Karnataka government is looking to raise the duty, and that remains the major concern for mining associations. Recently, even Union Steel Minister H.D. Kumaraswamy had a meeting with Law Minister and NMDC on the same issue, that how to approach the state government and convince them to take the bill back. Now, which of stocks will be in focus? First one is NMDC, for which Karnataka forms 35% to the total mix. Second, JSW sources major quantities of iron ore from NMDC. And third, 2 major stocks that will be in focus are Vedanta and Sandur Manganese, because they are the major producers of iron ore in Karnataka. But also needs to remember that this is the normal process for any bill to be passed. If a government in the center, if a government passes the bill, it goes to president for the nod. In the state, if government passes the bill, it goes to governor. So it's a normal process that's being followed. But this bill is important. That's the reason we are highlighting it.
No, absolutely fair point, and that's a very valid caveat as well that you've put in there, Sudarshan. Absolutely, this is just a part of the legislative process, but the governor has asked some questions. Now, when he sends the bill back, will the government make any tweaks and water down some of these provisions or not? That's what we have to see. But there's some green on these mining stocks today. Let's discuss this and more with Devin Choksi, who's with us on the show this afternoon. Devin, always a pleasure to have you on. Let's actually start there. I don't know if you have any interest in some of these mining and mineral and metal stocks, but your thoughts, Vedanta, NMDC. especially the ones that have a lot of dependency on the state of Karnataka?
Yes, Suvi, good afternoon. Well, I think there are a few thoughts immediately coming up. Definitely, I think India is on the capital expansion mode, creating large-size infrastructure. And I think the natural minerals are the ones I think which are definitely we are blessed with. However, I think what is most regrettable about this entire activity is that time and again, the regulations keeps on changing. And as a result of which, the businesses, I think, do not find this particular activity anywhere close to ease of this business kind of a slogan that we are promoting. I think that's the only challenge that we see. But otherwise, in my viewpoint, I think suppose if this particular bill is required to be revisited in the context of, I think, whatever the adversity it is creating on respective companies, I guess I think it would be more than welcome step as far as the market participants are concerned, and also by the corporates per se. Should that happen, in my viewpoint, I think it would be win-win, because I think those kind of retrospective taxes which they have levied in this bill is not heard anywhere in the world. So frankly, I think it is better and wisdom prevails that this particular bills be taken care of in totality.
Okay, that's the view on metals. Let's talk about IT. Midcap IT is leading from the front today. Look at Zensar, a stock we don't often talk about. The company reported growth in Q3, which came in as a positive surprise. So for the last 2 years in Q3, because of seasonality, furloughs and challenging times, the company was reporting a degrowth in the December quarter. But this time they managed to report a growth, and that itself was a positive surprise. Also, the other internal about deal wins, the highest ever order book at $205 million, positively surprised the street, and the stock is on a tear. But Coforge and Persistent deserve mention because these are two outperformers, not just this year, but for the last couple of years, these stocks have been outperforming. Persistent, for instance, is up 180% in the last 3 years. In the last 1 year, 12 months, it's up nearly 50%. And the reason is these two companies, both Persistent and Coforge, continue to deliver on growth quarter after quarter. This quarter, while frontline large-cap IT stocks struggled to deliver growth, TCS was flat, Wipro was rewarded for a 0.1% kind of revenue growth. A Coforge had a growth of 8.4%, while a Persistent was up 4.6%. So despite high valuations, because these are stocks on account of the re-rating they've seen, are now trading at 35-40 times FY27 PE. So significantly more expensive than the rest of the IT pack. But still, buying is very much, investors are latching on to these. Also, what helps is the growth prospects. These are companies which are confident about the future. Persistent is talking about a $5 billion revenue target for FY 2031. So that's, 6 years down the line. They're laying out the blueprint to achieve that kind of a revenue growth. Coforge not committing to any numbers, but very confident after the 40% jump in their order book. They're saying that it's going to be a robust, sustained growth. And we're seeing some big moves. But Devin, is the euphoria in these stocks justified? Like they've given a handsome return to investors, but a 10% pop on these numbers today?
Well, Rima, I believe that the valuations are always required to be looked at. And I think all these companies which you mentioned, they are priced, I think, a respectable valuation. In fact, I think in near term, I think they are expensive. So from a perspective of buying this company up fresh, unless I think the correction in the market price takes place, doesn't arise. Maybe I think one can argue that going forward, they may have faster growth compared to what I think they have had in the past. That will be one thing which one will be looking at, I think, in coming times. But as of now, I think from our side, we believe that engineering R&D space within the IT is looking relatively more safer because of, I think, the higher amount of visibility that they have created for the group. Though in some of the cases, they are expensive too. So unless the price correction is meaningful, I think one would not be immediately buying into some of these companies.
Okay, all right. That's Midcap IT, and that's been a really strong part of the market. Devin, the other, hallmark of trade this week has been the severe punishment that was first given to EMS stocks, and today is the reversal. Today there's a lot of buying that's happening. The debate is now that obviously they're trading at very elevated valuations, so the margin for error is very limited. What would your approach be? Would you advise some profit taking at these levels if someone has them in the portfolio? Or would you say that no, just hold on and in fact add at every low?
No, I think the valuation wise, everything is fully priced. I think so. Question of, I think, buying them at current levels doesn't arise. Maybe I think the market gives a significantly large amount of correction, if at all. Or maybe I think if it is a time correction after which you buy, That is the way to, I think, add into some of these companies. But I think currently everything is into price. I don't think that I think immediately one would buy into any of these stocks, even though they offer fairly good amount of runway as far as their growth is concerned. Still, I think the valuation matters.
Okay, all right, Deven, stay with us. I wanted to focus on UltraTech Cement, and that's the big mover in the last 30 minutes or so. The street was sensing a positive surprise, and boy, oh boy, don't these numbers look good. Toad-ford numbers, so to call it. The revenue number, well, that was better by close to around 150 crores in comparison to what we were working with. The EBITDA number, that was a pleasant surprise. It was up by close to around 100 crores in comparison to what we were working with, and that's why margins were better. A better operational performance has led to a net profit beat as well. A few factors I wanted to highlight. One is on the volumes parameter. We were expecting 8 to 10% volume growth. Well, they have grown by 10%. So at the upper end, which means that they've gone ahead and they've captured market share because the industry would have grown at around 5, 6, 7% very, very roughly. So they've outpaced the industry growth. Point number one. Utilization levels are around 73% because they've expanded capacity as well. Realizations on a year-on-year basis was expected to be down. It is down by close to around 10%. On realizations, they've recovered by close to around 1.5% on a quarter-to-quarter basis. And January, February should be better in terms of realization. So that's the other lever they have in store. So the operating profit, operational benefit is what they've got. And the other factor is the energy costs are lower by close to around 13% on a year-on-year basis, which has led the EBITDA per ton to improve by roughly around 230, 250 rupees on a quarter-to-quarter basis. And that's heartening. The street was expecting something around 200 rupees. It's improved by more than 250 rupees, and the street likes it. Additionally, the management commentary is positive. They're talking about rural as well as urban demand coming back. And they're saying that if that's the case, then 7 to 8% could be the volume growth going ahead. The numbers look good. The street likes it. If you want to be, in the cement pack, it appears UltraTech is saying people can, argue about valuations and the likes, but it's enjoying premium valuations and maybe rightly so, just going by these numbers. Your take?
So, Nigel, the commodities, whenever they have the larger amount of capacity utilization, I think they promise you for higher amount of volume-led growth. That's what we are expecting from UltraTech. I think the 73% capacity utilization that one has seen in the last quarter, in my viewpoint, I think in the fourth quarter, as well as I think in the next year's first quarter, financial year first quarter, the capacity utilization would probably remain on a higher side. That's the first point. Realization has been relatively better compared to previous quarters in the previous year as well, largely because of the strong demand impact, I think, which is coming from the market. And last but not the least, I think very important point out here, the margin protection, because the energy cost is remaining under control. It is remaining lower. Probably, I think you are getting the advantage of higher volume, higher capacity utilization on one side, and higher pricing on the one side. And at the same time, I think the lower energy cost, input cost on the other side. So it's a good combination. I would say that I think the business condition looks absolutely clear for me as far as I think the large size cement players are concerned, the pan-India cement players are concerned. And they could possibly surprise in the fourth quarter as well as in the first quarter of the next financial year by their performance.
Okay, so cement could be the dark horse as we move along this year. Got that point, Devin. Finally, before we let you go, we've had a flurry of earnings over the last 3-4 days so far this week, and some outsized reactions, whether it is Zomato, Swiggy, and then we've discussed obviously stocks like Dixon. Leave us with one stock, where you found the commentary, the earnings and the prospects, and even the valuations adding up, which you would look to buy maybe on dips, where the story is still intact, irrespective of the market mood.
So, Surbhi, from within the list of stocks which have come up with the earnings, I would think that I think within the BFSI space, particularly in the corporate banking space, Kotak could be one, I think, where you could possibly, I think, put bet on. The stock has underperformed historically in the last 3-4 years. And I think having got the corrective strategy in place with the better numbers that we have seen in the last quarter, in my viewpoint, I think the stocks offers the opportunity to, I think, give you 15 to 20% upside from current levels. So any corrective downside in the market, I think, is a bigger opportunity for buying likes of Kotak into your portfolio.
Okay, all right. Got that, Devin. Thank you very much for joining in and taking our questions today. You have a good rest of the afternoon. We do have to take a very quick break. And as we take that break, here's some good news coming in for our viewers. India's business news leader is now just a click away. Introducing the CNBC-TV18 all-new app. You can get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. You can download the app and, you can go to either Apple Store or Google Play, or you can actually even scan the QR code on your screen.
Okay, welcome back. Rajesh Bhatia is now joining us on the program, a CIO at ITI AMC. Rajesh, good afternoon. Good to have you with us here. Thanks very much for your time. You know, you in terms of sort of the size of the fund, I think is done very, very well. I think returns have been pretty good as well. And you yourself are someone who looks at slightly top-down macro, larger trends, etc. closely. And this looks like that kind of a year with a lot going on. But let's just start slightly micro, start from the market, and then we can broaden out. What's your sense? There's been a fair bit of damage which has already happened. Do you think it is enough? Somebody put it nicely that very high prices become high-priced. But my argument to that is things have been high-priced for about 10 years now. I mean, it's not, you got to go back a long time to find sort of cheap or whatever. Auto companies trading at 20 times, you have to go back to 2006, 2007, or for that matter, other sectors. So what's your sense? Has enough damage happened?
So Prashant, you're absolutely right. The markets have become far more macro-oriented, at least in the last 4 odd months. And that's really where the inflection points, at least on the drawdown lower, takes place. So it has become a macro-oriented kind of a market. But coming to that point of the micro, as you point out, I think, actually we have hardly corrected. We've corrected, 12% from the top, including mid-cap and small cap. Just that the mid-caps and small caps have corrected far more just this month. But otherwise, mid-caps and small caps have also just corrected 12% from the top. Even if I look at the last 2 years, my sense is that the Nifty should be up 35, 38%, and the mid-cap and small cap indexes for the last 2 years should be up 65+%. So in that context, the 12% decline is hardly any decline. And as far as Indian equities is concerned, I think you're absolutely right. Look, the opportunity and the growth rate and the ROE that India offers, right? So it's a high ROE. Why has India done so well over the last 43 years? Because apart from the growth rate, which is it is the fastest growing GDP nation in the world, the ROEs have been 16 to 18%, and long-term stock prices follow ROEs. So this is a very, very profitable market for businesses. And so it's very unlikely that if you're going to get something which is fast growing, over the next 10 years, we are saying that India is going to be one of the fastest growing and the most predictable, fastest growing nation in the world. The ROEs are going to be 16 or 18%. You're not going to get this very, very cheap unless a COVID kind of an event takes place. So this is going to be slightly an expensive market. But you're absolutely right. It's gone from extremely expensive to slightly expensive. It's not become cheap, but that's the nature of the beast we'll have to deal with. You will not be able to buy this very, very cheap.
So what does one do then, Rajesh? If things are still expensive after a 12% correction, what are investors doing? What should retail shareholders be doing?
So the challenge is not only the valuation. The challenge also is that we are experiencing a slowdown in the economy, right? And this is partly on the back of the fiscal consolidation that we've been seeing since the COVID times. And even next year, I mean, the fiscal deficit will go from 4.9, which is this financial year, and the government plans to make it 4.4. So fiscal will be a drag even next year, and which means that's not going to trigger your upturn. Now, given what's happened globally as well, with the dollar going up, with the interest rates globally going up, that has led to your Fed not being able to cut rates, and also that has implications for monetary policy, which means we'll not be able to cut rates as well. So you don't have a fiscal lever to drive up growth. You don't have a monetary lever to drive up growth. So the challenge is that we are into a slowing economy and the valuations are still high. So chances are very high that actually you'll go into a bit of a sideways correction, lower your expectations for this year at least, I mean the calendar year, as far as equity returns are concerned. So that's really where we are.
Rajesh, hi, good afternoon. So given that markets have been in this funk, I don't know, maybe people are expecting some magic to happen on the 1st of February. I don't know if it can be delivered or not, but what do you say? I mean, realistically speaking, would you want, want is fine, would you rather expect and pencil in some sort of a bigger announcement, whether it's on capex, infra or tax, or do you think it'll come and go? We have to deal with our own events here in the market.
So my sense is that this government has put macro stability ahead of growth, and it's always been conscious of macro stability. The fact that you have to bring your fiscal deficit down, because at 85% debt to GDP, we are among the highest or higher emerging market debt countries. So we will need to consolidate our fiscal deficit. So don't expect your fiscal deficit to rise and be a tailwind to growth. So I'm not expecting that. But you bring an interesting point. That, look, what has happened is that capex story of India was certainly abetted by the central government, which was at 3.2% of GDP or thereabouts. And of course, since the COVID, the capital expenditure from the central government was accelerating at 20+%. Last year, which is this financial year, it's gone down because we have underspent. And next year, even if you take a nominal GDP growth rate, which will mean that that tailwind from the government capex is definitely slowing down. What does it mean? And that's a question that we are also asking. What does it mean for order book growth for capital good companies, for instance? So those are the challenges that I think we will have to kind of navigate. Expect a lower fiscal deficit. Expect no tailwind from that. And that means that we will continue to be in a bit of a challenging environment for the next 12 months at least.
All right. Hi, Rajesh. Good afternoon and good to see you. When I recall you were pointing this out that in terms of sectorial churn, I think you were liking tech as well as pharma towards the end of the last quarter. And you were saying a lot of these cap goods, railways, defense plays, they seem to have run its course. Now, these stocks have corrected. Post the correction, would you have a relook at it?
So, as Prashant said in the beginning, these have gone from extremely overvalued to overvalued companies. They're still not cheap. And given the headwind that you were expecting some of these businesses means that, you have to curtail your enthusiasm, as far as those sectors are concerned. But we still continue to like IT, pharma, telecom, private banks. I don't think they'll make too much money for you, but it'll be a good place to be in. Insurance, again, these are very well-valued companies. You'll have to watch for some risk in the budget that may come. But I think these are the places where there's value, private banks and insurance companies, but don't expect too much in terms of returns either.
Okay, don't expect too much. So basically, curb your enthusiasm, right? As the title of that old show goes.
Yeah, curb your enthusiasm.
But single stocks, there will always be opportunities, right? In any kind of market, there is stuff which is. And do you think broadly, Rajesh, the market has changed in terms of what it will reward? So high PE, for example, did very well through the last couple of years, but maybe it has already changed, right? We're already, and it'll slowly start to show up everywhere. But which means that you've got to start to look at some ideas in the value space. Domestic-oriented companies, not too much dependence on China or the US, available at decent PE multiples. And I'm sure there are those kind of opportunities as well. You'd like to take us through where to look?
Yeah, so no, you're absolutely right. Professionals like us will be telling you a lot more now that it's a stock-specific market. And again, I think this is a market which is getting derated. So the derating means that the companies with the highest PE, those are the ones that become risky. Even if they are delivering, they become the riskiest to own because, you'll have a drawdown in terms of price earnings as well. So now when you say stock-specific, what does it mean? It means that, you should have some downside protection in terms of valuation. You should have greater predictability of execution. And that's really what it means, that you need to be a little more stock specific. And like I pointed out, I think telecom, IT, private banks, insurance. Of course, I have some digital commerce companies as well.
Right.
They add to my growth rate as well.
Okay, we'll have to leave the conversation here. But IT, telecom, insurance on your buy list and some digital commerce companies. But it's over to Shireen now. She's at the World Economic Forum at Davos. She's in conversation with Fateh Barot, the Executive Director of the International Energy Agency.
Greetings from a very, very cold Davos this morning, and it is snowing, as you can see. Joining me now for a perspective on the energy and commodity markets is Fatih Birol of the IEA. Mr. Birol, always a pleasure. Many, many thanks. It's snowing here in Davos. But what's the outlook now as far as the energy markets are concerned in 2025, given all the developments that have taken place?
Yeah. No, huge geopolitical tensions around the world, but when we look at the market fundamentals, supply, demand, and price, normally we should expect a comfortable year, 2025. In terms of oil, for example, demand of oil is getting weaker because of Chinese economy slowing down, mainly, and a lot of electric cars coming in the picture. And in terms of the production, we see huge amount of oil coming from US, Canada, Brazil, from the Americas, American continent. And as a result, we expect, as we said also last year when we were here, a more comfortable market. And as you know, in the Middle East there is a war, and oil prices are still $70 in the past. Remember, when there was 1/10 of this tension or conflict, oil prices rocketed up, and therefore comfortable oil markets, and same for natural gas markets, especially starting from 2026 and beyond, because again, huge amount of LNG coming from US and Qatar, 2026, 27, 28, and the countries like India, major LNG importers, should make their calculations according to the new wave of LNG supply coming from these countries.
Well, I'll talk to you about the LNG supply in just a second, but let's talk about the implications and the impact of what's happening with sanctions on Russia and how that's expected to play out as far as the energy markets are concerned.
So the sanctions on Russia, how far it will go and how long it is going to last is still not clear. And it's also not clear if there will be additional sanctions and at which level to Iran. This can have an implication for the oil picture I have highlighted. But leave aside these geopolitical issues, when we look at the market fundamentals, I expect 2025 would be a rather comfortable market.
A comfortable market as far as oil prices are concerned in 2025, given the supply-demand dynamics.
Like 2024 last year.
Like 2024, absolutely. But let's talk about the promise that President Trump is making now and how that could potentially impact the energy markets as well.
So these are very new announcements coming from the United States. We need time to see how these are going to affect the markets. One needs to look at it and study the impacts.
Absolutely. Assessment required at this point in time. India. Let's talk about India. We've got the India Energy Week coming up in February as well, both in terms of the market, also in terms of renewable capacity and the aspirations that India has. How are you looking at the story today?
India's economy needs to grow, continue to grow at a good pace. India is a very important member of the international community and has obligations for addressing the environmental issues as a developing nation. But in that context, I expect India Energy Week will be very important, especially highlighting the growing role of clean energy playing in India. According to our numbers, the clean energy investments in India 2024 last year increased by 40%, 40%. As such, India is one of the global leaders of clean energy investments around the world, especially for renewables. But my expectation from India is hopefully India will soon give an even more serious look at the electric cars.
More serious look at electric cars, but you also believe that 2025 is going to be a breakout year as far as nuclear energy is concerned. In fact, you put out a report saying exactly that. What's the case there?
Yeah. I mean, after the Fukushima accident in Japan, the appetite for nuclear around the world a bit died down. But 3 years ago, we said nuclear may make a comeback. And now, as of this year, 2025, I can confirm you that nuclear is making a comeback and a strong comeback. I give you a couple of reasons for it. 2025, this year, the amount of electricity produced from nuclear power will be the highest in the history.
Okay.
We have never seen such a big growth. Second, there are, as we speak now, more than 60 nuclear power plants are under construction around the world, the highest number since 30 years, 3 decades. And the third one is small modular reactors are, according to our analysis, they are going to hit the market around 2030. So these, when I put all of them together, nuclear being a secure and clean electricity source, I see bright prospects for nuclear power.
And a breakout here in 2025, as you point out. But, let's look at some of the risks as well at this point in time overall, as far as the markets are concerned. You talked about electric mobility. You also talked about data centers and, of course, what AI is doing. What is that going to mean in terms of consumption and also meeting needs of some of these growing areas?
The AI will have two different roles in the energy system. On one hand, for the AI, for the data centers, to run them, you need electricity 24/7. So it will be another driver of global electricity consumption in many countries where there is AI. I work very closely with, for example, Infosys.
Yes.
We look at these issues very closely. This is one role. The second role is AI, the artificial intelligence, can help us to run our electricity systems in the most optimal way. AI can help us to find the most cost-effective way of battery chemistry, so then bring the price down. So two roles for AI. On one hand, a real consumer of energy, and at the same time, on the other side, making energy use much more efficiently and energy production much more efficient and much more smart.
About India, we have them growing strong next year, consistent with what they grew this year. It's now moved to the 5th largest economy.
The Honeywell view on India, and how do you see the next few years?
Domestic business doing extremely well. Can't be more pleased in terms of opportunities in India.
It is, and there are lots of reasons for that. One is because he's in a much stronger position in the United States than he was in 2017.
They're working on AI. They're working on all the innovative capabilities that we want to input into our products. A lot of that's coming out from India.
If I were to say even heart and mind put together, India is an exciting story.
India is going to be the office of the world. You and I discussed about it.
Welcome back. You know what's happened in the last few minutes? A few stocks have come in for profit taking. So very quickly, let's pull up HCL Tech. That's moved lower. You have Nestle India as well. Now, these are stocks that are in the green. They have moved into the red. Even Hindalco has slipped a little bit. So a few of these names, they have come in for some profit taking. I think the IT index itself that was holding with strong gains, it's come off a wee bit from the top, and the Nifty Bank is down 120 points. Midesh Thakkar is back with us. Midesh, if you want to give a comment on the index and also a couple of trades.
I think, the index has become very quiet. The weaker index is the bank nifty. If it remains below 48,670, expect more declines to possibly 48,400, 250 zones. And therefore, I think, negative on banks. But a couple of IT names are quite positive, and a couple of other cement names as well. So I have a BTST on UPL with a stop at about 553 for targets of 566. And the other one is a BTST in Wipro with a stop at 314.5 for targets of 324.
All right, Mitesh, thanks very much for that. Well, look at the market. It's actually come off about 50 points or so from the high point, maybe a little more, right? Just about 40 points left now on the index. The high today is 23,270, and we're about 70 points off the highest point. Market breadth is still positive, but 1,600 stocks are higher and about 1,130 odd stocks are lower right now. Well, let's talk about more stocks, right? Strides, the last I checked, was up some 7-8%. And this is ahead of OneSource's listing on the exchanges tomorrow. OneSource is the demerged business of Strides Pharma. Let's break it down a little bit with Vinny, who's standing by to tell us more. Vinny, over to you.
Yes, absolutely. Strides has spoken about, demerging its CDMO business. Is going to be spinning off of its demerger, this business of the company. And OneSource will be listing tomorrow. That's January 24, 2025 on BSE as well as NSE. Now, in terms of calculation, what had also happened previously, OneSource, for every one share that you're holding in Strides, you would get 2 shares of OneSource Limited. So yes, that is the swap ratio that was there. According to analysts, OneSource stake is worth around 638 rupees, which is for each share. And the value for the continuing business would be 850 rupees. So for OneSource, we would be expecting somewhere around 600 rupees, while for Strides, it would be at around adjusted price of 850 rupees. That's according to what analysts highlight is coming in. So let's keep an eye out on both Strides as well as the listing of OneSource tomorrow.
Okay, all right, got that. Vinny, we'll watch out for this listing. We also want to get a quick heads up going on Dr. Reddy's. How is the performance expected to be in the third quarter?
Watching out for this time, this is the first nifty company that is coming in on, I beg your pardon, pharma company that is coming in with their numbers. Now, revenue, we are expecting a 16% growth in terms of revenue this time, EBITDA around 11% growth, while margins, some bit of a contraction is what we're expecting for margins. US sales expected to see a 10% growth YOY, but sequentially, the US sales are expected to be subdued overall for pharma as well as for Dr. Reddy's. So, US sales expected at $441 million this time. Top line growth, what will be driving it? That this time is the first quarter that they are going to be reporting numbers, including the acquisition that they made of nicotinamide. So yes, including those numbers, we're expecting a growth of around 16%. Revlimid sales, that is what we'll watch out for, because they're starting to now taper off, given that there's going to be a patent expiry that we're watching out for in 2026. So now the sales will start reducing for Dr. Reddy. So that's some bit of an impact of that. Now, other than that, domestic business is expected to do well, and that will be something that will be supporting the company's growth. So Sanofi vaccine licensing deal will support the growth on the domestic side, as well as the JV with Nestle is something that is expected to support the growth for the company. Watching out for commentaries coming in from the management. A launch timeline, especially for semaglutide in Canada, is something that is a key driver for the company going forward. And other than that, one or two large products that the company had indicated that they want to launch. So when is that going to be happening is something that we should watch out for.
Thank you very much for that. Zee Entertainment, which reports numbers later today, is seeing some big swings on either side. It rallied, then it fell. It's moved up again, 3.5% up on Zee Entertainment. And watch for Industars. That's another one that the street will be tracking in terms of numbers. Amrish Balika is now with us on the show. Amrish, before we get to the big movers of the day, tell us why Hindustan Zinc is on your buy list.
See, Hindustan Zinc is the largest and only integrated producer of zinc, lead and silver in India. Last quarter, in fact, they had the highest ever second quarter and half year for mined and refined metal production. The current capacity is about 1.2 million tons. EBITDA has been stable at around 50%, and they achieved the lowest cost of production in the last 4 years of US dollars 1,071 per metric ton. Now, silver segment contributes about 40% of the overall profitability, and now with the rupee depreciation, they'll again benefit further. From an ESG perspective and net zero commitment perspective, renewable power is about 70% of their total power requirement. And the new roaster should be commissioned this quarter, January-March quarter, and that should, in fact, increase the refined metal capacity further. They're also setting up a 510,000 ton fertilizer plant, which will be commissioned within a year, expected to be in Q3 FY26, and that should generate another EBITDA of about 450 to 500 crores. A great dividend yield company, is paid about 1,10,000 crores of dividend in the last 10 years. So expected EPS for FY27 is about 31, and my price target is 650, which works out about 11 times EV by EBITDA. And again, we have seen a decent correction in the last month and a half. So I think it's a great level to start buying.
Okay, all right. Amrish got that. Stay on. We'll come back with more questions. We do have to take a very quick break. Back with more market talk in just a bit.
Come back. Well, Amrish Baliga is still with us. Amrish, I wanted to ask you if you're tracking Syngene. It came out of the set of numbers. The stock has seen a sharp up move. Your take?
Nigel, I don't track Syngene, so a bit difficult for me to give a comment on that.
No worries. What about RBL Bank? You know, it came out of the set of numbers that looked rather disappointing, and they're scaling back in what they promised earlier as well. But the stock hasn't cracked. Maybe because it's been such a big underperformer, but it's not fallen below the price, ahead of its numbers. It was at around 155, 160 odd. It's holding in that band. How much of the bad news is in the price? Would you look to buy it, or would you just stay away?
No, in fact, we've seen a major underperformance from RBL, and it was correctly so, because the sort of a performance which we have seen, the asset quality issues. But then it seems that they're trying to put the house in order, and they really can't do that within a quarter or two. So I think we need to give them at least another quarter more. So at these levels, I would keep a close watch, no doubt, and it would be on my buying list. But then I would still wait for a quarter more and then decide. But then from these levels, I really don't see a major downside, unless, of course, there's a major negative surprise in the next 1 or 2 quarters, which I don't expect. So clearly, I'll keep that on the buying list, but not buy right now.
Okay. Amrish, hi, good afternoon. UltraTech, what a performance, right? Do you think this is something individual and specific to UltraTech that they've pulled off this fantastic show? Or do you think it could be a sign of things to come for other major cement players as well? And would you position for it? Would you buy anything right now, either UltraTech or any other stock?
No, see, as of now, it seems it is only as far as UltraTech is concerned that they've actually pulled out such a decent performance. Because overall, if you look at cement, I think most of them are under pressure as far as the margins are concerned. Again, if you see the sort of execution which had happened as far as the infra was concerned, like last year, it was much below expectations. And again, this year we will have at least 8 to 10% sort of a rise in the budgeted outlay. That's what my expectation is. But more importantly, I think the execution will actually take off this year. And that's going to help all the cement companies going ahead. So with a sort of, a performance which UltraTech has shown, clearly I think it's going to outperform going ahead. But at the same time, I would also look to buy other cement companies. Again, something like a Nuoco, which came out with pathetic earnings, it again corrected today. I think that's a buying opportunity.
Midcap IT, would you go out there and buy a Zensar, Coforge or Persistent, or avoid?
With the sort of a move which we're seeing in Coforge, possibly I'll wait for some time to buy. But yes, I think IT space overall, should be bought because again, when you look at what President Trump has been saying, that they need to make America great again, but they can't make America great again without Indian IT personnel and the companies. So they can't afford to ignore us. So going ahead, at least the next foreseeable, 2 to 3 years, I see things improving much better for the IT space. And we've seen underperformance from most of the stocks. So I think it's a great buying opportunity. So, if you're looking at the large caps, I would still go with the Infosys, TCS, and SCL Tech. And yes, among the mid caps, yes, something like a Coforge, but again, after a correction.
Any view on hospitals, Amrish? Name like Yatharth, which is sort of the flagship hospital, I think is in Thane, Rainbow, based out of Hyderabad. They've all corrected steeply, and generally the idea seems good. In terms of you look at healthcare costs and spending, etc. But have you looked at these businesses?
That's true. Yeah, in fact, I had given a buy on Yatharth, but after, whatever we've been hearing now in the market, I would be a bit cautious as far as this company is concerned. But overall, if you're talking of the hospital space, overall, clearly the spends are going up. Indians are able to afford more thanks possibly to the healthcare insurance which is there. So overall, the spends are going to increase because if you look at the sort of inflation which has happened in the healthcare space, that's at 2x to 2.5x of the normal inflation. And the way I see it is that's going to continue at least in the foreseeable future. So hospital space is clearly the place to be in.
Okay. When you said hearing things in the market about Yatharth, what do you mean, Amrish?
There were certain controversies. Again, I won't like to elaborate on that. But then since there are rumors as far as those controversies are concerned, I would prefer to possibly stay on the sidelines for the time being.
I see. That's important. We'll look up Amrish. Thank you for that. But, stay with us as well. And we'll continue this conversation on the other side. Just want to wrap up things. We're down 50 points on the Nifty, 23,200. So, decent kind of close. Yesterday it was about 23,100 and today 23,200. So slow and steady, but not falling anymore. The Nifty Bank down about 1/3% by close and 1 3/4 in the mid-cap index, small-cap index about 1% higher is essentially what we saw.
Well, in the large cap space, UltraTech Cement, top gainer, up nearly 7%. Grasim, Wipro, Shriram Finance, Eicher Motors, Sun Pharma, these stocks were up anywhere between 2 to 2.5%. On the whole, autos had a decent day because it wasn't just M&M, but even an Eicher Motors ended up in the green. Tata Motors had a gain of 1.5% and Hero Motor closing up more than 1%. On the way down, BPCL post numbers under pressure. HCL Tech has been the weakest large cap IT earnings so far, and that continues to come under pressure. Kotak Mahindra Bank, weak. SBI, Reliance Industries, that heavyweight tanked in trade, and HUL. Also on the red, ending in the red but off the high lows.
Yeah, and it's a good day of recovery for the mid-cap. Second day running, we've seen that recovery continue. Pidilite on the back of decent numbers, 5.5% higher. Swiggy managed to make a comeback as well, 6% higher. Zomato was up about 2% as well. These are areas where there's been a lot of price damage this week. Today was a day of recovery, and you can count in the entire EMS space in that light as well. So whether it's stocks like Amber or Dixon or a PG Electroplast, largely speaking, there were gains for most of these companies, Keynes, etc. Most were up and about in positive territory. But the day has to belong to mid-cap IT, thanks to some sparkling numbers that we've seen from the likes of Coforge. That stock's ending up about 11.5% on the higher side. The Zensar, 12% up. It took the entire pack up with it, actually. Sonata Software, 6% higher. So big day of gains for many of these companies. And finally, another trend, there's some buying re-emerging in PSUs and on decent volumes as well. So your NMDC, SJVN, RVNL, SAIL, BEL, some sparks of green on most of these stocks as well. Good day of recovery for mid-caps, almost 1,000 points up on the mid-cap index. Well, with that, it's curtains on this edition of Closing Bell. Thank you for being with us, but don't go anywhere else because we have Markets Forward coming up next in just a bit.